Okay, well, good morning, folks, or good afternoon if you are, it sounds like a lot of people from Europe here as well. I personally have a fairly global span in terms of the advisory stuff and the education stuff that I do, which has me actually right now over in Europe, in Switzerland, in Zurich. And well, let's say one more quick thing before we get started. What I'm about to show you guys today is not something that is only applicable to, say, stocks or indices. This will work for any asset class. So I know there's a lot of folks here, if I remember correctly, saying that they're trading currencies and things like that and futures. This is going to work in any asset class. So it really doesn't matter what you're focusing on. I'm going to show you guys this through the lens of equities and equity indices and things like that. But again, it'll work for anything. It's just a basic principle that we have to apply correctly. So we're going to talk about today's options, credit spreads for monthly income. Again, my name is Serge Berger from thesteadytrader.com. And I'll want to welcome you to today's presentation. Again, thanking Dan and his team for hosting us. Like Dan said, I've been very fortunate throughout my career to have worked both on the buy side and on the sell side. I've been able to thus become proficient or professional at many asset classes, from equities to fixed income derivatives, fixed income cash, and obviously various derivative instruments such as options. And now for the past 7 years, I've had my own company, managing money, doing education, advisory, the whole running the whole gamut. So it's wonderful to be able to pass that knowledge on to the broader audience as well. All right. Well, before we get into the meat of the presentation, I want to make sure that a lot of people seem to forget that it's important to keep it simple. And when it comes to keeping it simple, there's a couple important things we need to keep in mind. Well, most people make things too complicated because they don't really eliminate the noise. One of the biggest issues we face in the market these days, and it's really always been the case, but I think it's even more pronounced these days, is that there's a lot of noise out there through social media and many other outlets that we receive information from on a daily basis. It's just not really easy to keep this noise away. So what's important here is to have a straightforward process, and that's really one of the main reasons most people don't make money in the markets, because they don't have a process. So the more straightforward your process is, the easier it will be for you to be able to stick with it. I would like to ask for you guys to sort of keep that in the back of your mind as we work through the presentation today. So let's take this a step further. And one other thing quickly, I think a lot of people don't understand is how great an environment or time we live in for the self-directed traders and active investors, or long-term investors for that matter. We've got globally interconnected markets, social forces that are, basically pushing technology to become very mobile. So we can mostly do this stuff, like Dan and I said before, from anywhere. It doesn't really matter where you are necessarily, as long as you have a process. And that's kind of one of the main things that people forget, that even though we have all these tools, you can trade or invest from your laptop or from your iPad, you still need a process. And that's the main thing here that I'm going to try to portray. At the same time, from a liquidity and transparency perspective, we have more liquidity and more transparency for retail investors than we ever had with the advent of ETFs, or for those of you folks in Europe, CFDs. Individual investors really can play the world. So as a result, the medium-term market timing is becoming not only more important, but certainly, in my eye, simpler in that sense. So active investors at home really have a field advantage, in my opinion. So let me ask you guys a first question. Do you know someone, it doesn't have to be you, who has a profit or loss curve that looks something like this? In other words, you make a little bit of money, and then you lose it again, then you make a little bit more, and you lose it all again, and you can kind of see where this is going, right? I'm seeing a couple of honest people out there. This is the typical P&L curve for most people, right? And this is no shame. I promise you, my P&L curve looked at for way too long, but ultimately it is for every individual investor to sort of man up, if you will, and admit that this is what your P&L curve looks like, and only then will you be able to improve. Or, quite frankly, even worse, this is kind of, I guess, Peter, this is probably what it is. You lose some money, you make a little money, and you lose it all again, and so on and so forth. So that's really kind of what even more people's P&L curve looks like, particularly when the markets don't just go up in a straight line. When markets go up in a straight line, like we've had for the past 8 years, you know, it's not that hard to make money. It's more difficult when things get choppier, like we've had for the past few months, and that's when people's P&L curve really does start to look quite nasty. So I see a lot of people raising hands that this is kind of them. So listen, that's what exactly we're going to try to resolve for you guys today. So let's see. Let's go through a couple of pain points so you guys can kind of see where I'm coming from. I do things quite differently from a lot of people in the education field and also in the advisory stuff, in the sense that we, like I said, we focus on process. I don't like to just hand people a tool and say, listen here, go find your trades and promise you all sorts of riches. I promise you that's not going to work for anyone ever. You need a process. You can have a tool, that's fine, but you need a process that keeps you having perspective on the market at any given point. So let's talk about why traders need steady income. Monthly income is crucial for traders and active investors. The fact is that not having monthly income is one of the biggest pain points for private traders and investors. In other words, let me ask you this. How much more calmly, by show of hands, would you trade more calmly, okay, if you knew that at the end of the month, regardless of how you do, someone would give you $3,000, $5,000, $10,000, regardless. It doesn't matter how you do, you know, how much more calmly would you trade? Would you be more selectively with your trades? Absolutely, right? Everyone's raising their hand, of course. Exactly, and that's exactly the problem. So, in other words, what would you give to have that monthly income from some sort of a strategy? That's kind of what we're trying to go to. If, by the way, if anyone in here is retired or semi-retired, this is exactly, and anyone else, if you have a job or a part-time job, which quite frankly is the majority of people, what a lot of people forget out there that are trying to teach this stuff is that most people actually have another occupation. And even if you don't, there's a very small likelihood that you really want to sit in front of your computer 8 hours a day looking at the darn stock market or whatever market you're looking at, whether it's currencies or anything else, right? So income like a job without the pain of a boss is what we're looking for here, and that's the focus. I'm going to try to show you guys how we can get to that here with a straightforward strategy that is process-oriented. Okay, so for example, when I used to work at JP Morgan or other places where I've worked, you know, there's not really a big need to force trades because you're being paid a high, arguably a too high a salary, right? So one of the reasons why you're being paid that is, one, obviously, you know, banks like to make their recruits some kind of feel special, but it's also because of exactly that. They don't want you to force to feel the need to perform and force trades and do some kind of silly stuff. On the other hand, of course, that usually doesn't work out too well for most people at banks anywhere, until at some point they get fired anyway because either of underperforming or because the bank is restructuring, which tends to happen every 10 years or something like that. So the stress of volatile returns or having no steady income is driving most people nuts. That's the bottom line. So I've been there, and trust me, I never want to go back to that. So what I'm going to show you guys is how I managed to generate a steady income through a monthly or a quarterly basis that you can calm down dramatically in terms of forcing trades and really getting frazzled in general. So let's continue a little bit more along this line of thoughts. Private investors need regular income. Why? Number one, obviously we talked about the psychological aspect, but they need it to get into and remain in the right frame of mind. So let's take it a little bit deeper. If you are not in the right frame of mind, you cannot make money in the markets, right? It's a lot of it's psychological. So stagnating or losing accounts ultimately leads to a couple things. And everyone in here has been in this situation where you've had an account, you've done trades, right? You've done very well for a couple months, and you lose it all again, or maybe you lose even more than you made, right? How does that make you feel? You worked really hard for 2 months. How would that? Let's say you have a job, right? And for 6 months, and you get paid whatever, 5, 10, 15, 20 grand a month for doing whatever job it is you're doing. What if after 6 months, someone could take all that money away from you? Your employer could take that away just because you messed up a little bit. Well, that's how the trading goes. That's how the markets work. And that's what we need to stop, right? Exactly. It makes you feel like crap, Thomas is saying. So stagnating or losing accounts do two things. Number one, they'll lead to a loss of confidence in the strategy that you have, and ultimately, quite frankly, in yourself, which is really unfortunate, but it's true. And furthermore, it will tend to either you quitting, which is one thing, or it leads to breaking rules and forcing trades. Neither of these things are good. If you quit, then obviously you're done anyway. But if you end up starting to force trades and revenge trade, that's even worse. So in other words, if you revenge trade and break rules, you are no longer sticking to any risk management. You're taking on more risk and not adhering to any stops, and ultimately, you know where that ends to. It's just a downward spiral with basically a never-ending bottom. So, so that's it. So everyone feels better with a monthly income stream, which, quite frankly, is why most people like that security, quote unquote, of a job, right? That paycheck that comes in until they potentially ultimately get fired, right? But that's another discussion for another day. So how does this sound? I'm going to show you guys today, and I have a lot at stake here. So what I'm saying here is this is entirely correct. Is a low stress, high probability, and highly repeatable strategy. If you do this correctly and you look at only the qualified signals, which I will show you, it has a 80 to 90% chance of profitable trades, okay? Time requirement, very little. I wrote down an hour a week. Depends on how much time you have. You can do it for 2 hours a week. It doesn't really make a big deal, okay? So, for example, when I was working for a family office in New York City during the financial crisis, 2008, 2009, I had people sitting around me managing money, and they all did very, very poorly because they were trying to chase the market up and down in a very volatile environment. What I did is I applied this strategy that I'm going to show you guys today, and while I didn't make thousands of % returns, I did make very nice and steady returns regardless of the volatility of the market, because ultimately it was sustainable. So let's have a look at this. I'll give you a couple of ideas. So with this strategy, what I'm going to show you guys today, the market can either go in your desired direction. Let's say you can make a bullish bet, the market go higher. It can go sideways, or it could even go completely against you to a decent degree. And you can actually still make money, right? So in this case, let's say in this stock, again, this could be any asset class, but I'm going to focus on stocks just to make it uniform across the presentation today. Let's assume you made a bullish bid. Obviously, you'd make money in this strategy if you buy the stock, but you could also make money if the stock went sideways, or even it went against you for a little bit. So what we're going to talk about here primarily is when steep slopes turn vertical. Everyone has seen this before. You've seen a stock or index or a currency or a commodity ascend very steeply, and then just when you think it's done, it does something even crazier and it goes vertical. We've all seen that, but the key here, folks, is to be able to determine when this point of maximum bullishness occurs, and that's ultimately where the highest probability points of trades show up. Now, we're not trying to top tick the markets, not at all, but that's exactly why we're doing the strategy, because you're going to get a dramatically high probability. Same thing on the downside, right? If you have a stock that falls at first steadily, although in a steep fashion for some time, and then ultimately goes vertical, at some point it will be done, the sellers are exhausted, and it will begin to bounce, or at least stops going down. And those are the kind of opportunities that we're looking for, where you can consistently pull money out of the market on a consistent, either a monthly or a quarterly basis kind of thing. So let's have a look at this a little bit more closely. So a couple things happen when stocks or slopes, or again, whatever it is you're looking at, turn vertical. Number one, implied volatility will tend to increase or become elevated, which is actually something that a lot of people are not aware of. Even when the market rallies, I'll show you guys that in just a bit. Number two, investor fear or greed reaches complete extremes. And number three, the reward to risk for either a counter trend trade or simply literally actually a reversal are absolutely amazing if you structure the trade correctly, okay? And that's what we're going to focus on. So before we go a little bit deeper into the strategy, let me give you a little bit of overview here. So number one, here are some option selling statistics that you can kind of hang a hat on. So number one, the odds are strongly in favor of option sellers. In other words, if you look at options, you can either buy them or you can sell them, right? So the stats are like this: more than 75% of options expire worthless, which is to say that, if you are a buyer of options, you have about a 25% chance at most of making money, just, on the surface. The longer you hold your short position, the better your odds are going to be of success. Okay, so the longer you hold your short option position, the better your odds are of success. The other thing to keep in mind is that options are a wasting asset. Okay, so time is on the option seller side. Unlike when you buy an option, you have time basically ticking against you every single day, which is called theta. And lastly, option sellers on average win even if the market is going against them. Think about that. Even if the market is going against you, the option sellers actually tend to make money. So I want you guys to write these 4 steps down. Just like Dan said, I think taking notes is a really good thing to do here. So let's go through the 4 steps. Maybe you take a picture with your phone or your iPad or wherever you got to write this down. Doesn't really matter, but it's important to write these things down. So what we're going to do here is we're going to look at a 4-step process that's very simple, but most importantly, it's very repeatable. Number 1, what you want to do is you want to look for steep slopes. You want to look for slopes that have gone vertical and show signs of exhaustion. Number 2, we're going to ensure that implied volatility is elevated. We need to make sure that implied vol is elevated. Number 3, check for liquidity in options. In other words, you've got to make sure the options are actually liquid. Number 4, you then go ahead and you sell far out of the money call or put spreads. We'll talk about that in a second. 2 or more months out in the future. Okay, let me repeat that one more time. Once you've found the correct setup, the actual strategy will be to sell far out of the money call or put spreads 2 or more months out into the future. You then rinse and repeat that on a monthly basis. So let's have a look at a couple of examples here. You can see, for example, in this case, we had a stock, and again, this could be any asset, just to be clear, that rallied very steeply. It then went vertical, and after that got exhausted. Well, the stock didn't, in this case, in the strategy I'm going to show you guys, doesn't have to fall apart for you to make money. It just doesn't have to explode even higher from here. In other words, it could go sideways. It could even go a little bit against you to the upside, but it doesn't have to fall apart. Okay. Another example here, this is actually the stock price of Netflix. So you can see we have a steep slope. Okay, this is already a steep ascent. Ultimately, that went into vertical overshooting mode. And as you can see, ultimately the stock here stalled. It began to stall, and it didn't go higher anymore for an extended period of time. Right? It didn't fall apart completely. It basically bounced back and forth, kind of going sideways in a very choppy fashion. So let's take this a little step further. When slopes go vertical, right? In other words, when they on the upside, then the upside is capped, and if slopes fall apart sharply, then ultimately the downside becomes quite floored. Right? Now, we're going to mostly focus on the upside here with a couple examples on downside as well. In other words, the asset will then tend to stall in price, and you will see this over and over and over again. When something particularly in the upside, if something rallies too strongly, okay, particularly out of an already steep slope to the upside, and then it goes vertical, it will tend to stall and start to mean revert, or at least go sideways, right? So oftentimes there's going to be a sharp mean reversion to the downside, but that's kind of your bonus. We don't even need that. We don't even need the stock or the underlying asset to fall apart. We just need it to kind of stall a little bit. So let's look at some example trades. Here, for example, we have the chart of a stock called Facebook. I'm sure plenty of you have heard of this. If you haven't, maybe you've using the product of theirs. And you can see, and you can't see it as well in this chart, but this chart, this slope here, this channel, is actually an already steep ascent. Okay, but what happened out of the steep ascent, you can see several times we attempted these vertical moves, and each time we got rejected right back into that channel. Okay, so it's the verticality of this move. That's a word that's important for us. So let me show you what I did. Here's the P&L curve, payoff diagram, which we don't need to look at for now. But what I did, for example, on February 2nd, 2016, okay, I sold what's called an April 125-130 call spread, taking in $1 of credit. Okay, so let me show you guys where that is on the chart. I'm going to show you guys the real chart here so you can see that here. Okay, so this is the chart of Facebook and what we did February 2nd, 2016. You can see we already had a steep upslope, the stock that went vertical, all right, and started giving us buyer exhaustion signals. So on February 16th, I sold an April 125, 130 call. So I sold a 125 call, which was up here. And then I sold, I bought against that, excuse me, 130 strike call. So before we get into the mechanics of the trade, let me quickly show you what this means. So I have now seen that this stock, in my opinion, has gotten overbought. Not only has it been in a steep slope, but it just now went vertical and also reached, by the way, reached or marginally overshot the upper end of this trend that had been in place for some time. Okay, let me actually make this stick here. So now at this point, I'm seeing a stock that goes vertical, but instead of shorting the stock, which is not something I would do, I said, listen, I'm not willing to make a direct downside bet, but I'm willing to bet that this stock is probably overbought, which is to say that in this case, the stock could have gone about 8 or so, actually, sorry, about 10% against me, okay, and I could have still made money. So whether the stock goes lower or sideways or up to 10% against me, at expiration, I could have still made money. You guys see how the dramatically better probability of you making money in this trade? If I would have shorted the stock or bought a put, anyone, a show of hands, if I would have sold the stock, short the stock, or bought a put, what is the only way in which I would have made money? Can anyone tell me? Right, exactly. I would have only made money if the stock went lower. But in this case, not only does the stock not have to go lower, it can also go sideways, and in this case, it can go up to 10% or more against me, right? And I took in a credit of $1. So let's fast forward and see what happened. Well, what happened on February 8th, the spread was reduced to 24 cents, which means I bought back that spread and got to keep 76 cents, or i.e. $76 of income. Now, if that's a foreign language for you, let me walk you through a little bit more. As the stock started to drop, in this case, it mean reverted lower quite quickly, okay, the net credits reduced. So I took in $1 or $100 per options initially, and as the stock dropped, ultimately this spread was only worth 24 cents. So I bought it back for 24, so I spent 24, and ultimately I got to keep the difference between $1 and the 24 cents, which is 76 cents or $76 per one time I'm doing this. Now, this in and of itself isn't even that important. My main objective here for right now, so you can start using this today or tomorrow, is that you understand the power of looking for slopes that are steep and go vertical, and then that's when you execute this kind of strategy. And instead of selling it or shorting a stock or buying a put, if you would have done this trade, not only is it much safer, okay, but also you're going to sleep much better at night, right? And the little thing here is that if you note, this took place in February, but I used April options, right? So I had all the way until April, which is like, you know, in this case was like 3 months or more until expiration. I'm sorry, no, but 2.5 months or so in expiration to be proven wrong, which is a lot of margin of error, and that's exactly why this strategy works so well the way I do it. Yeah? Yeah, so weekly options is not something we want to do. We'll talk about that a little bit later. Weekly options are an awful strategy, in my personal opinion. I'll show you guys why in a bit. Let's look at another example, okay? So here is the chart of Tesla. And again, this could be anything. This could be a stock. This could be an index. This could be anything else. It doesn't really matter. But you can see, again, we had an orderly decline, albeit a fairly steep decline in percentage terms, and ultimately the stock fell apart. So what did we do? Well, on February 16th, and let me now also take you to the live chart. Actually, I'll keep you here on this chart. On February 16, 2016, as the stock went into vertical deceleration mode, and by the way, the implied volatility spiked like crazy. This is down here. What happened is I sold a June 120, 110 put spread. I took in a net credit of $2.25. Let me show you guys this. I'm going to take up the other chart so you can see this. Okay. So this is the chart of Tesla, and this is exactly what I'm showing you. It's the same chart, all right? And you can see, again, the market fell apart, and then ultimately it went into like vertical drop mode here into February 2016. Well, what I did once we started getting very exhausted and we started to see exhaustion signals, and I'll show you guys in a minute how that works, we sold a June 120, 110 put spread. Well, at the time when I did this, and I didn't do it right at the bottom, I waited for the stock to stabilize. I think the stock was June 16th, but the stock was trading around $155. I sold a June 120 put, which at the time was about 20% out of the money. Okay? In other words, at this point, when I did this, not only could I make money if the stock went higher or sideways, it could go more than 20% against me, and I could still make money by June expiration. Well, again, in this case, you can see the stock then quickly rallied, but it didn't have to. I'll show you guys in a minute for me to keep these profits, right? So by March 16th, which is about a month later, this spread was reduced to 43 cents. Again, I bought back the spread. I got to keep the difference between 225 and 43, which is $1.82 or about $182 per option one time I'm doing the option spread. Okay? So we'll talk about how we make a portfolio out of this in here in just a minute, but let's give you another example of a stock in this case that didn't go up or down very significantly. And I'll show you guys exactly how we're going to find these turning points in the stock, as well as see a lot of people asking. Okay, so here is LinkedIn, and you can see LinkedIn again. We had a fairly orderly decline, and then the stock just completely fell apart. It got very oversold, came into a technical support area, and that's all good and well. Well, at that point, what we did, and this was let's see, this was in also February 2016. We sold an April 90 85 put spread. So here's what that looks like in real time. So you can see here too, again, the stock fell apart, and after it started stabilizing, we saw a lot of stuff come together. We ended up selling a 90-85 put spread. So in other words, and we did it on February 8th, and the stock at that point had not yet reached bottom. In fact, it went a little bit lower, so it was about here. Okay, so we sold a 90, which is down here. So the stock could have dropped another, let's call it 15%. I could have still made, and I would still make money by April expiration, but it didn't have to. It didn't have to drop. It didn't have to do anything. You know, it could just go sideways, which is exactly what it did, right? So the stock went sideways, and ultimately by March 16th, this spread was reduced to 43 cents. So again, same thing. I bought back the spread, and I got and ultimately, actually, this one actually we let expire. We let expire entirely, so we got to keep the 95 cents entirety because the stock just went sideways. And again, so the point for right now, folks, I want to show you is that you see that the stock didn't have to rally, right? It didn't have to do anything. In fact, it just went sideways. And as you can see, I got to keep the entire 95 cents. And I was planning this trade ahead. I was planning it ahead in February for the month of April, okay? And so I'm generating income for the month of March or April by looking ahead. That's the key here, and that's why this is an income generation strategy, okay? Okay, so let's take a quick intermission here and go through a couple other things before I show you more examples. The objective here is not to pick winners, but rather to stay out of losers, particularly in a strategy like this. Because by doing so, the winners and profits are automatically going to take care of themselves. This holds true for any trading and investing, quite frankly. It's about playing defense. Most people out there try to play offense, and they're hectically day trading currencies, stocks, whatever you have. I promise you that's not going to be the way you make money over time. You're not going to make money that way over time. You can have a good month or get some kicks out of that, but you're not going to make money over that with that over time. That's not really a sustainable strategy. Okay? So, of course, you can have some losing trades. That's inevitably part of trading and investing, which is why it's all about risk managing. Okay? So you also have to make sure that you give yourself time. That's really, really, really important. Let me quickly go back to this example here. Okay? In other words, what you're doing here, you are making a bet on where the market is not going to be at a certain time in the future. In other words, if you're buying a put or a call, or you're buying a stock, or you're buying a currency, what's the only way in which you guys are going to make money, right? It has to move in the direction in which you're betting. But by doing this, we are taking that equation out. By doing this, you're giving yourself more than a 2/3 chance of making money, just because you don't have to, because the underlying asset doesn't have to go in the direction that you want it to go. It can go sideways, it can go in your direction, or it can even go against you to a good extent if you do it correctly, okay? So option buyers and stock traders only make money if the stock goes in the direction, and they're making a directional bet on where the stock or option is going to be, or the index or the currency or whatever you're doing. But stock traders and option buyers only make money if the stock goes in the direction. But option sellers, they can be totally wrong and still actually make money. So it's a matter of thinking differently. Does that make sense, folks? Okay. I will teach you guys how this works in more detail in just a second. Okay? Okay. So you got to give yourself time. This is really, really important part of the strategy, and that's what most people don't do right. If you are going to be selling options, okay, for the most part, particularly if you go for the really high probability stuff where stocks where the charts go vertical, which is what I'm showing you here, you've got to give yourself time, okay? And perfect timing is not necessary. Many traders fail because they don't give their ideas adequate time to work out. So you got to plan your income stream months ahead. That's really, really important. But most people aren't patient enough, and that's one of the biggest detriments for people why they're not making money. And much of that is because they structure the trades the wrong way, okay? They're buying premium as opposed to selling premium the right way, okay? So I want you to think of these credit spreads as regular income. When you got to treat them as swing trades, or as a bonus, if you will. So in other words, I would like for you to think of these credit spreads as your bread and butter strategy. And anything else that you do, anything that's swing trading related or anything like that becomes your bonus. And of course, this is in addition with your long-term investing. But if you treat the credit spreads the way I've shown you, and I'm going to show you guys a ton more examples in just a second, as your regular income, okay, then you are going to be planning income ahead, and you're not going to have that issue of frantically trading. Does that make sense, folks? By planning your income ahead, and that's what we do. So at the first few days of every single month, and we look through these opportunities through every month, my primary objective is also always to look for opportunities to sell these credit bets so I can generate income looking ahead, 1, 2, 3 months into the future. Because the more I put on these trades, I put on 2, 3, 4 new ones each month, I'll always have these trades expire, hopefully worthless, i.e. keeping most of the credit, say 1 or 2 months into the future. Okay? So I'm going to go and show you guys in a minute how we determine when something's overbought or oversold in just a second. Okay? The other thing is, guys, that returns in trading and investing are inevitably going to be non-linear. Anyone that promises you that you're going to make exactly $500 a day or a week or month, they're lying. It doesn't happen that way, But that's why we have to plan ahead and basically create a portfolio of these kind of trades going forward. Now, one way that I found, and I'm going to give you guys this later on, give you a chance to get this for free, okay, is with an indicator that I have. The indicator will find these dramatically overbought, oversold stocks with just a click of a button, so you don't have to do a whole lot more, okay? So we'll talk about this a little bit more, but I have this, which is going to allow you to find these vertical charts, so you don't have to, spend hours a day for stuff. You'll find the high probability setups. It's going to force you to develop a watch list and keeps you from buying or selling at the exact worst spot. And more importantly, it forces you to be patient, calm, and collected. So I'll show you guys how you can get this for free here in just a minute. But first, what I'd like to do is I'd like to show you guys a couple more examples that are a little bit more real-time oriented. So for example, let's go through a few examples here. One of them we just did in the Clubhouse, which is my membership thing just the other day. So for example, Boeing, okay? This is ticker symbol BA, and I'd love for you guys to show me some tickers or stocks that you would like to look at as well, so I can show you if something might be viable there. But this is a classic example of a stock like this, of this kind of a setup. So you had a very strong rally, and again, this can happen with currencies as well, and I'll show you guys in a minute, okay? And ultimately, this very strong rally went vertical. Well, guess what? At some point, this stock became very, very overbought, okay? And at that point, we had a beautiful opportunity to sell these out-of-the-money call spreads way out of the money. We could go, 5-10% out of the money and make a bet that the stock is not going to go much higher. Maybe it only goes to, here, right? So you could sell something like a 260 call spread using options expiring a couple of months out into the future. And in this case, the stock doesn't have to go lower. It doesn't have to go sideways. It can even go against you a little bit, and that's exactly how we're going to make money. So let me show you, for example, how this worked. I'm going to quickly type this up here. So you can see, for example, we had here. This is the indicator that I showed you before, just as an FYI. I'll show you guys how you can get the indicator for free in just a minute. You can see the indicator gave us an overbought signal here, and sure enough, the stock corrected or didn't do anything for a while. Same thing again here, right? You could have sold out on money call spreads, and most prominently, just again here in late, about a month ago, okay? You can see stock got very overbought. We got the signal. We got a whole bunch of them in the stock, basically then just started going sideways, okay? So that's important to keep in mind. What other tickers do you guys want to go through? What other stocks would you like to have a look at for this? Let me give you a couple other examples. Let's see what other people are asking. Sure. Yes. Freeport-McMoRan is actually a good example as well. Okay. So you're looking, for example, at the Freeport-McMoRan. We actually had a signal here where the stock got very overbought. Okay. Here's the actual chart of the indicator, and you can see the stock got very overbought here. Okay. I'll show you here on this chart here. Let me just quickly bring it over. Oops. Sorry, lost the chart here, and sorry guys, 1 second. And here, we'll go back to this in just a second. But you can see here, here's what happened in Freeport-Mac. We got overbought, and you had an opportunity to sell out of the money call spreads right here. Same spot. We're just looking at different charting platforms here, right? And the stock then consolidated and didn't really go higher. Okay. Yes, of course. We'll talk about a losing example in just a second as well, so you guys can see how you manage the trade, right? It's very simple. It's actually very, very simple how we do that here in just a second. Let's see. Someone else wants to look at what did you guys want to look at? Google. Yep. Let's have a look at Google. All right. Okay. Same thing, same principle in Google, right? Let's have a look at Google. Okay. And you can see here too, it's the same principle. The principle is when a steep start chart goes vertical. Again, we had a nice orderly rally, but then it goes vertical, and at some point it gets so exhausted, right? You have a beautiful opportunity to sell out of the money call spreads. Okay. So with this strategy, if you use it correctly, like I said, you have an 80 to 90% chance of making money in any given trade. But you got to use it correctly, and that's why I'm all but teaching you the education rather than just handing you a fish. Okay. So let's see here. What else? What other trades did you guys want to look at? Let me quickly bring this over. Okay. I'm just trying to bring up the chat window here. Sure, Lululemon, absolutely. So here, for example, is Lululemon. Okay, and you can see the stock, and this guy's actually this is an example of the indicator actually giving us just a very clear overbought signal. The stock had rallied so much that it didn't even go vertical, but you can see same principle happened. They got overbought and had a beautiful opportunity to sell out of the money call spreads and make money. Okay. Okay, are you guys understanding the basic principles of the strategy so far? So we're looking at, like we just so far said for the past what has it been, 40 minutes, we're looking for steep slopes that are getting dramatically overbought, right? At that point, you get a point of extremes where emotions are too strong, bulls are getting too bullish, right? And that's ultimately where you're going to get a beautiful opportunity to sell, in this case, out of the money call spreads, yeah? Okay, this is about credit spreads, right? Not about debit spreads. In other words, we're looking to sell options as opposed to buy options. What we're looking to do every month is roll into new opportunities. Okay? we're taking in credits by selling these spreads, okay, like we just talked about for the past 40 minutes, exactly the way I showed you. We're looking to take in the credit. We're looking to sell an option closer to the money and buy an option against it. And we're taking in a net credit for that, okay? So again, by so doing, like for example, we did just here in, let's go back to BA just to show you guys an example that's current. And by so doing, we're giving ourselves a much better probability here. Let's go back to Boeing. Okay, you can see the indicator in this case gave us a signal that the stock was dramatically overbought, right? And so instead of, so when the stock got dramatically overbought in late July, not only was this a bad opportunity to buy the stock, which the indicator gave us, or our process, it was a beautiful opportunity to make a bet that the stock is not going to rise much further, right? Does that make sense, folks? We're expressing a view giving us a higher probability chance of making money. So the stock doesn't have to drop. It doesn't even have to go sideways. It can even go against us if we do this correctly to a decent degree, and we're looking to generate income by placing these very selective trades. Okay, I typically, as Mike is asking how many trades you find each month, I typically find about between 2 and 5 of these trades every single month, and I look to place them, look to place new trades like this every month. So right now, for example, we're looking to place these trades using options that expire in the month of November and December, because we're looking for those trades then to for those trades and to basically expire worthless, and we get to keep that money, generating us income for those months out in the future. So you guys have a lot of great questions. I'm gonna get to this stuff in just a minute, but let me quickly show you guys what I would like to offer you guys. I'm gonna offer you guys my Options Income Secrets course today, where you're gonna learn all the details of this so you can generate income on a, let's say, monthly or quarterly basis. It's a very low stress, high probability cash flow strategy. You can use options the way the pros do, because usually pros don't buy options. They tend to be sellers of options for the most part. Again, the probability, if you do it correctly, and that's why I want you guys to have the education, is about 80 to 90% chance winning trades. You get a bonus ebook with this. Is a recorded video series. You'll never go away, okay? And it's just $197 one time. And I'm going to show you guys 1 second. You're going to get the indicator for free. I'm actually tossing it. It's a brand new indicator. We just completed it a few weeks ago for the public. So if you go to thesagetrade.com/income, you'll get all this. So let me continue here and then show you more examples. Let me quickly type this in here for 1 second. Let's see here, .com/income. And this is going to go to entire audience. Okay, so I typed the file link in there. So let's go a little bit further. There's a brand new module in here that is going to, it's called the Pro Strategy. It's called the Iron Condor, where you basically can actually even double your income selling your income from selling options if you plan out the trades looking a couple months ahead. So again, it's just $197 one-time fee. That's it for learning the income generation strategy over time. And now I'll address the thing on weekly charts on weekly options in just a second, guys. Okay. Also, if you get this, you'll get a personal mentoring phone call with me. You can ask me any questions about options, option selling, whatever you want, and I'll show you how we can make this work and how we can put a plan in place for you to make money. Okay, this is about finding very selective trades, because all we're trying to do is we're trying to generate cash flow, over a monthly or quarterly basis, so that you can sleep at night. To me, that's the most important part. And it's the major reason why most people don't make money, is because they're forcing trades because they don't have that income. Okay, so it's a very selective strategy. We got to find the right trades. Also, there's a live bonus session you guys can attend if you buy this today. It's called we just basically go through more details, tips, and tricks. Wednesday, September 13th at 11 a.m. Eastern time, so you can come in there and ask any further questions. But that's basically going to give you guys now about a week's time to really go through, watch all the material if you'd like to, and go in and really learn the stuff and come back with more questions. But again, you also have the phone call with me. Lastly, okay, now I'll talk about weekly options in just 1 second, folks. Also, what I'm actually going to throw in for free today is, and we'll talk more about the course in just a second, but basically the course is all about making sure you guys can generate income, okay? It's making sure that you understand the odds of doing option selling correctly. Most people that sell options, in my opinion, don't use it correctly. They use weekly options, or they overtrade. They don't find the qualified trades. I see a lot of people asking about weekly. Is anyone here would like me to focus on weekly options for 1 minute? If you raise your hand if you'd like me to quickly go and demystify the weekly options. And I'll tell you why that's a really bad strategy, okay? But in the course, you learn a ton of stuff. You learn why the odds are dramatically in favor of option sellers, the power of time decay, and how theta literally allows you to make money in your sleep, how you can put on trades over long weekends or on vacation, understanding the importance of implied volatility, how to use implied volatility to your advantage, and further dramatically increase the probability of successful trades. So this is a comprehensive course on using a very selective and specific options trading strategy so you can generate income over a monthly or a quarterly basis, which is the most important thing in my opinion. You want to be able to turn this into a monthly income machine, and that's what I'm here to show you, and I'll answer all your questions, more questions in just a second. You also want to be able to diversify the strategy among different sectors, industries, asset classes, or different, well, like I said, different asset classes, right? You can use this using currencies and futures or indices or whatever you'd like to do, okay? So we'll teach you where to take profits and how to risk manage stuff when you have a losing trade and all sorts of stuff like that. So it's a really comprehensive course. Now, let me quickly tell you that I'm going to include for free today, this indicator is brand new for the public. I'm going to include for free, and I'll probably never do this again. I'll include it for free today, is the scanner and the indicator that allows you to find these extremities. Okay, it's called the TST Vertical Pro. If you purchase the course, you will get, the course itself is $197, and includes, again, it's an evergreen course. It never goes away. You always have access to it. You get the ebook along with it. You get the live bonus sessions on September. You get a personal coaching phone call with me, and you get the TST Vertical X Pro for free. This indicator itself is going to sell for, I think, $197 once it goes to the market in the next few weeks. You're going to find these extremely overbought and oversold conditions with the click of the button. It works right now. I'll show you. It works for Thinkorswim. It works for TradeStation, and it works for eSignal. Excuse me, for TradeStation. I'll show you. For a NinjaTrader, I'll show you in just 1 second. Yeah, so you can have an opportunity to find stocks that have vertical charts. You'll find the highest probability sets for options, credit spreads. It's going to force you to develop a watch list. Really important. Most people don't know how to make a watch list because they don't know what to watch for. And it's going to keep you from buying or selling at the exact worst spot. So it's going to force you to be patient, calm, and collected. Okay, so right now it works for TradeStation, for Thinkorswim, and for NinjaTrader. Now, again, keep in mind that this indicator is just a bonus. Like, what you're really buying here is the course, the coaching, the live mentoring, the live sessions, and everything. So this is just, I'm throwing this in as a bonus for free. Like, I've never done this. We just launched it, but I would like to give it to you guys because I feel like the market is about to go a little bit crazier. So I want to give everyone an opportunity to get this. So let's talk about weekly options. Okay, so the reason why weekly options are a bad idea is for the following reason. Let me just go through quickly, and sorry, let me get back to this up here. Okay, so the reason that weekly options are a bad thing, or for this, and I know a lot of you guys, ask about this. Okay, so what happens when you trade weekly options? You don't give yourself enough time. And I see here Steve, Posney, David, TJ, Maria, Michelle, Lindsay, you guys are all asking, Tom, all asking about weekly options. The reason why I don't like to use weekly options is because time is, it's not allowing me to give myself enough time, okay? So let's look at BA, right? So I'm giving myself a great opportunity to make a bet that this stock at this point, after having gone literally vertical, I mean, look at BA, and I still think there's an opportunity to do this trade, by the way, okay? This stock has literally gone vertical, okay? The indicator will find you that, will tell you that, okay? And theta is going to work for you, exactly. So what we don't want to do, and that's why everyone that teaches these weekly options strategies are you know, I don't want to call them out or badmouth them, but they're ignoring one big thing. A weekly option at the end of that week where you're holding it turns into a binary option. Okay, most of the time, if anyone in here has ever worked with a weekly option, you know what's going to happen on that expiration Friday, right? You're going to sit there on that expiration Friday, and you are going to not move away from the screen because you don't know if the stock is going to close in the money or out of the money, or the options are going to close in money or out of the money, and that's going to drive you nuts. It turns into a day trade, and you don't want that on a Friday. So that's just the psychological part for you, for your lifestyle. But you don't give yourself any time. For me, in order to be able to go out and sell an out of the money call spread in this case, let's say 5% out of the money, right? I can do it 10, 15% of the money if you get a stock that has a higher implied volatility. I don't need this stock to immediately do something. If you do a weekly trade, you're essentially, in my mind, you have a way too close a time frame. Okay, you're not giving yourself enough time. You're not giving yourself any breathing room, and you're not going to be able to sell options this far out of money to get juicy premiums, right? So I don't really care what this stock is going to do over the next couple of days unless it dramatically rallies against me, right? In which case I quickly get out. But that's another thing. If you let me ask you this, for those of you guys are asking about weekly options. What happens? Let's say you do weekly option today, an option that expires on Friday. What happens if that option goes very quickly against me, like by tomorrow? You're pretty much going to take maximum loss, right? If I were to do a trade right now, right? If we do this trade right now, then this stock can rally against me, and I'm not going to lose that much money because if I use options that expire, let's say in November or December, I still have plenty of breathing room. And in addition, we're trying to generate income with this strategy, right? That's what we're trying to do. We're not trying to make a weekly short-term, almost like a day trade. We're trying to generate income going forward. So this has a much higher probability of making money over time. It's much less hectic. And again, on that Friday, expiration Friday, you are not going to be sitting there looking at the screens the whole day. Okay? Yeah, exactly. That's it. So we're looking at trying to generate income through a monthly or a quarterly basis using a very steady and repeatable process. Yeah, so I mean, again, like John is asking, some other people are asking here about the indicator. I mean, the indicator is just a bonus, right? I'm literally just tossing it in for free, you know, and it's going to find you these very steep slopes. You know, the indicator is the bonus here. It's basically, I'm just tossing it in for free today as a one-time thing ever. What you're primarily buying, guys, is an education here. It's just a one-time fee. There's no recurring fee here where you are going to learn the detail of this strategy, right? We'll have a live bonus session on September 13th. We're going to you can have a personal phone call with me where I'm going to work you through. Again, I will include the indicator for anyone for free, but right now it works primarily on Thinkorswim translation on NinjaTrader. Okay. Yes, I do have a trade alert service, David, but that's something different. This is an education. Unless you guys the indicator cover. The indicator is, you have it for always. It doesn't go away. It's just I'm giving it to you. It doesn't. You'll have it. Okay, it doesn't go away. Once you have it, I can't take it away from you because you'll own it. You know, you can do whatever you want with it. That makes sense, Steve? So David's asking about trade alerts. So this is not a trade alert service. This is education. I do have a trade alert service, and you know, if you guys once you guys purchase the education, then you can sign up for the trade alert service, and it's called the Clubhouse for me that I have, if anyone's interested. But that's a different thing, and that's not part of this. What I want you guys primarily is to first learn, because I'm very selective in who I accept in the Clubhouse, because I want people to understand the process so they can understand what it requires to make money in the market. But again, let's go through the process one more time. So if in this case you can see, and in fact we did this trade just a few weeks ago. The stock had a very steep rally. It then went vertical and got very exhausted. Now the indicator itself gave us a selling signal, but you didn't have to, like, if you don't have the indicator, it's not the end of the day, right? No, this is not the gap service monitor. This is something else, okay? Yeah. So listen, this is not necessarily a time decay trade, Thomas. What we're looking to do is generate income. It's very important to find the key spots where a stock gets very overbought or oversold, and that's where we're looking to do a strategy. And you learn it all in great details in the course. Again, this is a recorded video series. It'll never go away. It'll be yours to keep forever, along with the ebook, along with the indicator that I'm giving to you, along with the personal coaching phone call with me that I'm offering to you, and along with the bonus webinar session that's going to take place on the 13th of September as well. So you have 1 week now if you'd like to, and go through and learn this in detail. But the point is, we're not trying to necessarily play theta. Theta will come into account in the end. What we're looking to do, and that's what I said before, if you want to generate income in the market, you have to plan ahead. In my opinion, of doing this for 20 years, if you are short-term oriented in your option selling, you're going to lose money over time because you are making too short a trade. It ultimately has like a binary outcome, you know. So what we're looking to do is we're looking to right now plan income ahead for the month of October and November. So we're looking for charts that are extremely overbought, like Boeing and others. We're looking to sell out of the money call spreads so that these spreads are going to decay, and we're going to get to keep the money for income for the month of October or November whenever we close the trade. Okay, the indicator itself indicates when a stock is extremely overbought or oversold. And again, I'm just to be clear, the indicator I'm just tossing in for free for today. We just launched it, and we're actually officially launching it. I just want to give it away for free today because I haven't, you know, I've literally just come to the market with it. I've used it for I don't know, I want to say 1 or 2 years or so, but we haven't come to market with it. It finds extremely overbought or oversold stocks where you'll be able to sell out of the money call spreads to make a quasi-bearish bet, or inversely if something is really oversold. Okay? Yeah, so you'll learn all the details about the strategy in the course. That's what the course is for. Unfortunately, I only have an hour and 15 minutes here, so to go through everything. But that's what the strategy does. Yeah, Paulette is asking, will this work if you're new to spread trading? It's absolutely, that's exactly what it is. It's I want you guys to primarily, like I said before, I would like everyone to understand that if you want to make money in the markets as an active investor or trader, or even as an investor, what's your primary objective, right? Primarily, you're trying to make income, because if you don't have income, you're not going to be able to have a level. You know, a healthy mindset to be able to make money. So that's what this is for. Because if you don't make money, or, you know, we've talked about earlier in the webinar about your P&L curve. Let's say you make money for 5 trades in a row, and then you lose all those 5 trades money in one trade, which happens basically to everyone. That's the bottom line with most people trade. It's going to drive you nuts. But if you have an income strategy, that's your primary strategy, where you know you can generate income through, let's say, a monthly or maybe a quarterly basis, which I think is more realistic, then you don't have to constantly force these trades. Does that make sense? No, I'm not an advocate of weekly options at all, whether you're buying or selling. You know, to me, that's way too short-term oriented. You know, again, I've done this for a long time. That doesn't make me a better person, but at least it's given me experience that I think that's way too short-term oriented for either. Because if you're buying weekly options, you can lose money from time to time, and if you sell them, again, you ultimately end up with a binary option at the end of the month. So, you know, listen, by all means, if you find a very overbought or oversold stock, try it with weekly options, but I think you'll find much better odds if you use options that expire out at least 1, 2, maybe even 3 months if you get the time, because you're going to be able to sell stocks much further out of them, or options much further out of the money, right? So if I were to sell, for example, in Boeing, right? So if I wanted to right now, you know, I mean, the better time would have been when the stock was really overbought here actually about a month ago. You had an opportunity to get a lot of credit, right? A lot of income for making a bet, let's say, using October options, as opposed to using August options, which was much closer. So you'll be in a much better spot to be able you want to improve your margin of error. right? You want to give yourself as much leeway as possible, right? That's the whole point in all of this. Yeah. So the more net credit you take in, the more you can go out of the money to take that credit in, right? So if you're selling, in this case, let's say a 260, 270 call spread, then all we're doing is we're making a bet that this stock, which is very overbought, is not going to go much above 260 at expiration, which means you can make money whether it goes sideways, lower, or even against you up to this point here. Okay? Paula, this is not a brokerage firm. I'm simply selling you guys education. That's all it is. This is education so you can properly plan ahead of an income stream. And that's really the key with all this, guys. It's about planning ahead an income stream, right? So let's look at some other examples that I know some of you guys were writing to me before about. 1 second. Let me just quickly get to the right platform here. Yeah, so for example, let's look at Apple, right? So you can look at Apple here. We actually, the indicator in this case gave us a very overbought signal here in May. Well, in the stock, it didn't fall apart, right? But it stopped going higher. And those are the points we're trying to find. You don't need an indicator for that, right? It's nice to have, right? But that's the points we're looking at. Again, look, this was in, let's see, May of this year. So let's have a look at this on the other chart, May of this year. You go in here. Let's pull up Apple. May. So this was this point here. So you can see, again, it's the same principle. And again, you'll learn much more details, of course, in the course about how to find these things and qualify it and all that stuff. I only have, about an hour or so in these webinars. But as you can see, this was already a very steep slope, and then the stock went vertical. And then that's the opportune point to sell out on money call spreads, because again, you're not making a directional bet. You're simply saying, listen, I think the stock from here is not going to go much higher for right now. David's asking, how wide are your option spreads? And are they $10? It depends on the stock, David. If I'm looking at a $20 stock, they're not going to be 10 points wide. It's usually maybe about 10% of the stock price or so is fair, right? Yes. It didn't go higher. No. Sorry. Okay. So the signal came here, right? So what we did here is we sold an out-of-money call spread, right? And then, of course, you got to take profit at some point, right? So in this case, maybe we planned the stock ahead for the month of June, right? Well, this stock, Apple did not get back to this break-even point here until, let's see, June, July, like what, 3 months later? Okay. So I wouldn't have sold, in this case, it was May, I would have sold maybe a June or July option, right? So anyway, again, there's much more detail, of course, you'll learn in the course, but that's the point here, right? Because let's say I would have shorted the stock, you could have done that, but you would have only made money if the stock would have dropped, right? Does that make sense, Larry? So there's a big difference here between buying a stock, in which case the stock has to go higher to make money, or selling a stock or a currency or whatever, and selling calls or put spread, okay? Yeah, okay. So in my basic rule to take profits, and again, you guys will learn this much more in the course, is if the net credit depletes by half. So let's say I took in a net credit of $1. If it reduces by half, that's when I have to take at least 50% off. Okay. My personal guideline is always to look for selling options at least 1, potentially more like 2 months out into the future. That's my general guideline. How much capital do you need to make 2-4 trades a month? Well, that really depends how much you're looking to make. I mean, to me, I think you can. I think over time, and this is really difficult to say, but I don't see. Yes, exactly, Larry. 2 transactions. Yeah. Yeah. So if the spread, yeah. I mean, I don't know. Listen, I mean, you can do this strategy if you have $5,000 or $10,000, but you know, the key here is not to think in terms of reward. The thing is to think in terms of risk. That's the primary importance. So what we're trying to do is we're not trying to make money on a daily or on a weekly basis. We're trying to plan income ahead for the next month or the week or the month after, or the month even after that. Okay? Yeah, exactly. Sure, I can go through the offer again. So the indicator will be sent to you, Lewis. Don't worry. I will make sure that's something that's going to be sent to you. But again, I need you guys to understand, this is not about the indicator. Okay, I'm giving you that for free. Primarily, you guys need to learn how this works. That's why I'm offering this. Okay. Again, you get an evergreen course. You'll have access forever. I wouldn't do it with a $1,000 account, Rin. No. I wouldn't trade with. I wouldn't trade anything. I would get a job if I had a $1,000 account. No offense. Really, I mean that sincerely. A lot of people try to trade with $1,000 accounts. I think that's lethal. I would not offer that. I would not encourage that to anyone. So again, you're going to get the monthly options income strategy course. All the details. You're going to get the ebook. You're going to get the personal mentoring phone call with me. And we are also going to do a bonus webinar on the 13th of September at 11 a.m. And again, I do include the indicator here, but again, just keep in mind the indicator here is I'm just giving that away for free. That's important. Okay, yes, let's have a look at that. Yeah, I agree, Thomas Holland, on that comment there. That's awesome. Totally, yeah. You don't want to look at that stuff. That's silly. Okay, so let's have a look at a trade that did not go well. Okay, let's have a look at that. I'm going to try to quickly remind myself of one. Give me just one quick second. I'm trying to remind myself of, oh yeah, I'll show you one here. I'll show you one that I did this spring, I believe, or was it this summer? Here. Okay, so what we had take place here, this was in Halliburton. I'll show you this. Okay, this is shares of Halliburton. In fact, let me just make this a plain white chart, because the moving averages here aren't that important. Okay, so what I did here, so you guys can see, it can go wrong, but that's why we do. But that's exactly why we sell options 1 or 2 or 3 months into the future, because the damage will be minimized. Okay, that's a hugely important factor here, Michelle. I think you're asking here. Okay, so look at this. This is Halliburton. I was of the opinion that the stock was very oversold at this time, and it did bounce. I wasn't even incorrect, but I never closed it. Okay, but so I sold an out-of-money put spread here. But then we had one nasty bearish reversal here, and that's usually when I get out. Okay, that's when we get out. So that's this here. Okay, so Michelle, to give you an example, to give you an idea, that's usually the first. We basically get out the first sign of concern. That's to answer the question simply. But exactly in this case, if I would have sold a weekly option, I would have lost most of the money here if this would have happened. But because in this case I didn't use options I used options that expired in September, this wasn't a big deal. And again, we're looking to plan income not for today or tomorrow, but for the next month or the month after that. And we do this every single month. So at the end of the day, within 3 months or so, you can have options expire, hopefully worthless, and you keep the income on a monthly basis. Does that make sense, Michelle? You're asking a great question, and I hope this example is giving you a good idea. So you get out at the first bearish reversal in this case, and that's exactly why you use options that expire a couple months in the future. Give ourselves that safety cushion. If you did this with weekly options, you'd be done, right? So yes, the indicator works on Thinkorswim. It works on TradeStation and NinjaTrader. Exactly. Cool. All right, so Michelle, does that make sense, that example? So, this is, like I said, I mean, this strategy, if you use it correctly, you're going to get about 80 to 90% profitable trades. You're not going to get 100%. Nothing works 100%, of course not. But the drawdowns are very small if you use options that expire a couple months in the future. And again, we're not looking to generate income for today or this week. We're looking to generate income through a monthly or even preferably through a quarterly basis. Yeah? Excellent. Okay, so again, what this is a course, an evergreen course. You are going to learn all the details on how to structure this correctly. A lot of people lose money selling options, and there's really no reason for them to do so. And the reason why they do is because they are essentially over trading. That's the easiest way to put it. So you got to make sure you give yourself time when you sell options. That's really the key here. You get the bonus ebook with it, with the course. You can go to the studytrade.com /income. It's just $197. And again, it's also going to include a personal mentoring phone call with me. And it just means it's a course. It's a recorded video series, an evergreen course is what that means. It's a recorded video series you'll have access to like forever. It doesn't go away. And I just added a bonus session actually on what's called I call it the Pro Strategy, which is an iron condor if you do it correctly. Yeah, you're very welcome, Steve. Steve says thank you. We'll also do a bonus session on Wednesday, September 13th. And again, we are also going to be, right now, for those of you guys that purchased today, only today, this is it. I'm only offering it today, right now. If you purchase this right now, then you will get for free my Sagittarius Vertical X Pro Indicator and Scanner. Well, you'll find these extremely overbought and oversold conditions where you can then do these trades. So, you know, you don't need this. You can probably find it yourself, but it takes a long time to find it. That's why I created the indicator, and it works very, very well. So the indicator right now works for Thinkorswim, TradeStation, and NinjaTrader. Cool. Well, listen, with that, I think I'm going to wrap it up here. Let's see here. Also works then. Traders Workstation. Is Traders Workstation, is that no, it doesn't work as a standalone. You need a platform. Is that Interactive Brokers? Yeah, no, nothing's going to work in Interactive Brokers. I promise you. For one, they don't even allow us to program for them, and B, you unfortunately can't find anything for that platform. I wish, to be honest with you. Yeah, I know, I wish. Anyway, folks, listen, thank you so much. You've been a great crowd. Again, it's the studytrade.com/income if you want to take advantage of this. Again, I want to thank you all for joining here. I think there's a great lineup of speakers here coming up still. And I'll shoot it back to Dan.